Welcome back, everyone. We're diving deep into the world of 100 baggers today.
Ooh, one of my favorite topics.
Yeah, mine too. I mean, who wouldn't love turning a $10,000 investment into a cool million, right? We're talking about stocks that return $100 for every $1 invested.
Absolutely. And we're going to be using 100 Baggers by Christopher Mayer as our roadmap for this journey.
So is finding one of these elusive stocks like hitting the jackpot at the casino? Or is it more about skill and strategy? Can anyone find these 100 baggers, or is it just pure luck?
Well, there's definitely an element of luck involved, no doubt about that.
Sure.
But there are also patterns and principles that we can learn from.
Okay, so let's break it down.
Yeah.
What exactly is a 100 bagger? Define it for our listeners who might be new to the concept.
A 100 Bagger is simply a stock that goes up 100 times from your initial purchase price.
Like if I bought a stock for $1 and it went up to $100.
Exactly. Or if you bought a stock for $10 and it went up to $1,000.
Got it.
And that $10,000 investment, boom, $1 million.
Wow. That's the kind of math I like.
It is pretty amazing.
So where do we even begin to find these elusive 100 baggers? What's step one?
Well, the book talks about something called the coffee can portfolio, which really captures the essence of this investing approach.
Okay, the coffee can portfolio.
Picture this. Back in the day, maybe even the Old West,
Okay.
people used to store valuables in a coffee can and just tuck it away, like under a mattress or something.
Right.
And they'd let it sit there for years, maybe even decades.
So are we supposed to start hiding stock certificates under our mattresses? Do businesses really even last that long?
Well, not literally, of course, but the idea is the same. Finding the best stocks and just letting them sit for the long haul.
Okay, so it's a set it and forget it approach to investing.
Exactly. And it's a strategy that's actually been proven to work.
Really? Give me an example.
The MIT Endowment Fund is a great example.
Okay.
Back in the mid-20th century, they achieved incredible returns by simply holding on to stocks for decades.
Wow. How long are we talking?
Like in 1949, their average holding period was 27 years.
27 years. That's insane. Nobody holds stocks that long these days.
It's a completely different world now, with high-frequency trading and algorithms making trades in milliseconds.
Right.
But the lesson from the MIT Endowment Fund is clear.
What's that?
Patience is key for long-term investing success.
Okay, so find the best stocks, hold on to them for years, maybe even decades.
That's the basic idea.
But let's be honest, isn't the hardest part actually having the patience to sit tight through all the inevitable market ups and downs?
You're absolutely right.
I mean, I can just imagine myself getting antsy if a stock wasn't moving for years, wondering if I'd made the wrong choice.
It's definitely a psychological challenge.
Dude, how do we deal with that?
One way to really focus on understanding the underlying business rather than getting caught up in the daily stock price fluctuations.
So we need to trust in the fundamentals of the company.
Exactly. If the company is executing its plan, growing its earnings, and creating value, the stock price should eventually follow.
You know, the book tells this cautionary tale about an investor who sold their Berkshire Hathaway stock at just 48 cents a share.
Ouch. Talk about a missed opportunity.
Right. But even with a company like Apple, which turned into a 225 bagger, I'm sure there were some pretty scary moments along the way.
Oh, absolutely.
So even the biggest winners don't just go straight up.
Even Apple had its share of gut-wrenching moments.
Really?
Investors who held on to Apple stock from its IPO had to endure 80% peak-to-trough losses before reaching those incredible returns.
Wow. So even with the biggest winners, you have to be prepared for some wild rides.
That's where that coffee can mentality comes in.
Right.
By adopting a long-term perspective, you're less likely to make rash decisions based on short-term market noise.
Okay, so patience and a strong stomach are key.
Absolutely.
But let's say we're ready to build our coffee can portfolio.
Okay.
What are some characteristics we should look for in potential 100 baggers? How do we separate the wheat from the chaff, so to speak?
The book emphasizes a simple but powerful formula: high growth over a long time.
So we're talking about companies that are consistently growing their earnings year after year.
Exactly. Companies like Tractor Supply and Monster Beverage are great examples.
I've heard of those companies.
They've both been phenomenal success stories.
How so?
Well, Tractor Supply achieved a 100-bagger return in just 12 years by growing its earnings at an average rate of 23% per year.
23% per year. That's impressive. And what about Monster?
Monster Beverage was even faster. reaching 100-bagger status in just 10 years with an amazing 50% annual growth rate.
50%. That's incredible. So high growth seems to be a common theme here.
It's a crucial ingredient in the 100-bagger recipe.
But is a high growth rate all we need to look for?
Well, there's another important factor to consider: multiple expansion.
Okay, explain multiple expansion.
It's basically about how much investors are willing to pay for a dollar of a company's earnings.
Okay.
Think of it like this. If a company earns $1 per share and investors are willing to pay $10 for that $1 of earnings, that's a price-to-earnings ratio, or PE, of 10.
Okay, so the PE ratio.
Right.
So the higher the PE ratio, the more investors are willing to pay for each dollar of earnings.
Exactly. And when a company's earnings are growing rapidly and investors get excited about its future prospects, that PE ratio can expand, meaning they're willing to pay even more for each dollar of those earnings.
So the stock price goes up even faster.
Exactly. Monster Beverage is a perfect example.
How so?
Its earnings grew 25-fold during its run to becoming a 100-bagger, but its stock price actually increased 125-fold.
Wow. So it's a combination of earnings growth and multiple expansion that creates those truly explosive returns.
Precisely.
Okay, so we've got high growth and multiple expansion. Where else should we be looking for these 100 baggers?
The book suggests that microcaps, which are companies with a market capitalization under $300 million, hold a lot of potential.
So smaller companies that might be flying under the radar.
Exactly. Think about it. They have more room to grow compared to those big established corporations.
It's like finding a hidden gem before the rest of the world catches on.
Exactly. Many of the companies we know and love today, like Starbucks, Microsoft, and Home Depot, they all started as tiny microcaps.
Wow. So those small companies can become giants.
They sure can.
And there are a lot of them out there, right?
Oh, yeah. Around 40% of all U.S. companies are microcaps, so it's a vast pool of potential waiting to be explored.
That's pretty inspiring. But with so many to choose from, how do we even begin to narrow down the search?
That's where understanding the alchemy of creating 100 baggers comes in.
Okay, the alchemy of 100 baggers.
There's a fascinating study by Motilal Oswal that looks at the Indian stock market and breaks down the key ingredients that are common to these high-performing companies.
Okay, so what's the recipe? What goes into making a 100-bagger?
The first ingredient is a favorable macroeconomic backdrop.
So a stable and growing economy.
That's right. It's like planting a seed in fertile soil.
Makes sense.
The second element is having a capable management team.
So we're looking for strong leadership and a good track record.
Exactly. We want companies that are led by skilled, ethical people who are aligned with shareholder interests.
Got it.
The third element is a sound business model.
What does that mean exactly?
It means the company is selling something people actually want and need, a product or service with staying power.
Not just a passing fad.
Right.
Right.
We're not looking to invest in the next pet rock or fidget spinner.
So far, we've got a good economic environment, strong leadership, and a product that people want. What's next on the list?
The fourth element is a reasonable starting valuation.
So even if a company has all the other ingredients, we still need to make sure we're not overpaying for it.
That's right. It's about finding value relative to the company's growth potential.
So it's like finding a balance between what we pay today and what we think the company will be worth in the future.
Exactly.
Yeah.
And that brings us to the final ingredient, the power of compounding.
Oh, yes. Compounding. I've heard that's the secret to long-term wealth creation.
It is. Compounding is what turns small gains into substantial wealth over time.
So explain how compounding actually works.
Imagine a snowball rolling downhill, gathering more and more snow as it goes.
Getting bigger and bigger.
Exactly. In investing, it means earning returns on your returns.
So it's like earning interest on your interest.
Precisely. And the longer you let your investments compound, the more dramatic the results become.
So it's about being patient and letting those investments grow undisturbed.
That's right. Think of it like planting a tree.
Okay.
You wouldn't keep digging it up every few weeks to check on its progress.
Right. You have to give it time to grow.
Exactly. Building wealth through 100 baggers is all about nurturing those investments over time and trusting in the power of long-term growth.
I'm starting to see the bigger picture here.
It's a long game.
It is. And it requires a different mindset than just trying to score a quick win in the market.
Exactly. It's about building a legacy.
I love that. Building a legacy.
It's about creating something that will last for generations.
And is there any way to tell if a company has this ability to reinvest those profits at those high rates you talked about?
You're thinking like a pro. One metric to watch is return on equity. or ROE.
Okay, ROE.
It tells you how effectively a company generates profits from the money invested by shareholders.
So it's like a measure of efficiency.
Exactly. Think of it as a company's batting average.
Okay.
A high ROE means they're consistently hitting home runs.
Okay, so give me an example of a company with a high ROE that turned into a 100-bagger.
Sure, Home Capital Group became a 49-bagger in just 15 years, and they had incredibly high ROEs, consistently ranging from 15.1% to 31.6% annually.
Wow, so they were really good at turning shareholder investments into profits.
They were, and that's what allowed them to reinvest those profits at high rates and accelerate their growth.
Okay, so we've got ROE on our radar now.
Yeah.
You know, this reminds me of that Seinfeld episode, The Stock Tip.
Oh, I love Seinfeld.
Yeah, me too. Remember the insider, Wilkinson, who George follows around?
Yeah, the one with all the skin in the game.
Exactly. Does that concept apply to finding 100-baggers?
It absolutely does. Owner-operators, people who have a significant ownership stake in the companies they run, tend to outperform the market
Why is that?
because their interests are aligned with ours. Their success is directly tied to the company's performance.
Makes sense.
Think about companies like TransDigm, Danaher, and Colfax. They've all been incredibly successful under the leadership of owner-operators.
So we should look for those owner-operators who have skin in the game.
Exactly. They're the ones who are most likely to make decisions that benefit all shareholders.
And speaking of exceptional CEOs, The Outsiders by William Thorndike profiles a bunch of CEOs who were absolute rock stars when it came to capital allocation.
Oh, yes. The Outsiders is a fantastic book. It's full of insights into how these CEOs generated phenomenal returns for their shareholders.
Did any of them create 100-baggers?
They sure did.
Give me an example.
Henry Singleton, the CEO of Teledyne, turned the company into a 180-bagger.
180-bagger. Wow, how did he do that?
Well, he was known for ignoring short-term earnings, focusing on cash flow, and buying back massive amounts of the company's stock.
So he was a contrarian.
He was. And he had a remarkable ability to see value where others didn't.
And did any other CEOs from the book achieve similar results?
Tom Murphy of Capital Cities created a 204-bagger.
Wow. Another massive winner.
And John Malone at TCI achieved an astounding 900-bagger, which translates to a 30% annual return over 25 years.
900-bagger, that's just mind-blowing. What was their secret sauce?
Both Murphy and Malone were masters of acquisitions, reinvesting profits wisely, and, you guessed it, buying back their own stock.
It seems like stock buybacks played a big role in a lot of these success stories.
They can be an incredibly powerful tool when used effectively.
How so?
When a company buys back its own shares, it concentrates ownership and earnings in a smaller number of shares.
So each share becomes more valuable.
Exactly. It's like slicing a pie into fewer pieces. Each slice gets bigger.
Okay, that makes sense.
Think about AutoZone. They reduced their shares outstanding by 88% over 20 years, which was a huge factor in their journey to becoming a 100-bagger.
Wow, so they essentially shrunk their way to success.
In a way, yes. And then there's Lowe's, which bought back a whopping 90% of its stock, turning a $100 investment into $1,240 over 5 decades.
Those are some seriously impressive results. So buybacks can be a powerful engine for growth.
They can, but it's important to remember that they're not always a good thing.
Okay, so what should we watch out for?
You want to make sure the company is buying back its shares at a price that's below their intrinsic value.
So they're not overpaying for their own stock.
Exactly. Buybacks should be done strategically, not just to boost earnings per share in the short term.
Got it. So we've talked about high growth, multiple expansion, microcaps, owner-operators, and buybacks. But before we get too carried away with all the potential upside, we need to talk about risk.
Absolutely. Risk management is crucial.
And one of the best ways to manage risk is to invest in companies with strong moats, right?
You're right. Moats are those durable competitive advantages that help protect a company's profits from being eroded by competition.
So it's like having a castle wall to keep the invaders at bay.
Exactly. And just like there are different types of castle walls, there are different types of moats.
Okay, give me some examples.
Some companies have incredibly strong brands, like Tiffany's or Oreo.
You love Oreos.
Me too. Those strong brands allow them to charge premium prices and command customer loyalty.
Makes sense.
Other companies have high switching costs, making it difficult for customers to leave.
Like banks.
Exactly. It's a hassle to switch banks, even if another bank offers a slightly better interest rate.
True.
And then there are companies with network effects, where the value of the product or service increases as more people use it.
Like Facebook or eBay.
Exactly. The more users they have, the more attractive the platform becomes.
So those network effects create a powerful barrier to entry for competitors.
They do. And some companies have cost advantages that allow them to undercut their rivals. Exactly. Their massive scale gives them tremendous bargaining power with suppliers, which allows them to offer lower prices to customers.
So when we're analyzing companies, we need to look for those strong moats that will help them stay ahead of the competition.
That's right. And it's also important to consider the industry dynamics.
How so?
Some industries are inherently more profitable than others.
Right, like software companies tend to have much higher profit margins than airlines.
Exactly. And some industries are more vulnerable to disruption than others.
Okay, so we need to pick our fishing spots carefully.
Precisely. You want to fish where the fish are biting, so to speak.
So to sum it all up, what are the key takeaways for someone who's on the hunt for 100 baggers?
Look for companies with high returns on capital, the ability to reinvest at high rates, and large, growing markets to expand into.
Got it.
Seek out those owner-operators who are passionate about their businesses and have a significant ownership stake.
Alignment of interests.
Exactly. Think independently. Don't be afraid to go against the crowd. And remember that patience is key.
Okay, I think I'm starting to get the hang of this 100-bagger thing.
It's a fascinating journey.
It is, but we've only just scratched the surface.
We have a lot more to cover.
There's a whole world of 100-baggers out there waiting to be discovered.
And we're just getting started.
So stick with us as we continue our deep dive into 100-baggers.
We'll be right back after a short break. And you know, one of the most intriguing aspects of 100-bagger hunting is the importance of thinking independently.
You mean not getting swayed by all the noise and hype?
Exactly. The market's not always rational.
True.
Fear and greed can really distort valuations.
Yeah, I can see that.
And that creates opportunities for those who can stay focused on the fundamentals.
So it's about having the courage to go against the grain.
Precisely. Being a contrarian can be very rewarding, especially in the world of investing.
But it takes guts to stick to your convictions when everyone else starts to be running in the opposite direction.
It does. That's why it's so important to do your own research.
Right, not just follow the herd.
Exactly. You need to understand the businesses you're investing in and have confidence in their long-term potential.
Makes sense.
That way, even when the market gets turbulent, you'll be able to weather the storm.
You mentioned earlier that sometimes the best opportunities arise during times of crisis, when fear and panic create those fire sale bargains.
That's right. When everyone else is selling, that's often the best time to be buying.
It's like finding treasure amidst the wreckage.
Exactly. And speaking of learning from the past, there's a great story in the book about Benjamin Graham.
The father of value investing.
Yeah, him. And a valuable lesson he learned from a fellow investor named Albert Dix.
Oh, what was that?
Dix had this uncanny ability to avoid those major market crashes.
Really? Was he some kind of market psychic?
Not exactly. He was just really good at managing risk.
Okay, so how did he do that?
Well, he recognized the dangers of using too much leverage and the importance of preserving capital.
Especially during times of uncertainty.
Right. He understood that market cycles are inevitable.
So he was always prepared for the downturn.
He was. The book tells a story about how he warned Graham that a correction was coming.
Oh, did Graham listen?
Unfortunately, no.
Oh, no.
Graham, who was heavily invested at that time, dismissed Dix's warnings.
He thought the party would never end.
It seems that way.
And what happened?
When the crash came, Graham's portfolio was decimated.
Ouch.
She lost something like 70% of its value.
Yeah, that's a tough lesson to learn.
It is. And it highlights the importance of being open to different perspectives.
Even when they challenge our own beliefs.
Exactly. Sometimes we need to be willing to listen to those who see things differently than we do.
Humility is a virtue, especially in investing.
It is. We can all learn from each other's experiences.
So we've talked about learning from history, managing risk, and being open to different viewpoints. How does all of this tie into our search for 100 baggers?
All of these lessons are essential because they emphasize the importance of developing a long-term perspective and a resilient mindset. Remember, the path to 100-bagger returns is rarely smooth sailing.
Right. There will be bumps along the way.
Exactly. The market will test your conviction. But if you've chosen your investments wisely, if you've done your research and believe in the businesses you're invested in, you'll be much better equipped to handle the ups and downs.
So it's about building a portfolio that can weather the storms.
Precisely.
Yeah.
And understanding that market cycles are inevitable.
Okay.
Periods of exuberance,
Wow.
irrationality.
Like the dot-com bubble.
Exactly.
Right.
Those periods will always give way to periods of fear and pessimism.
So the key is to not get caught up in the emotional swings of the market.
That's right. You need to stick to your strategy, focus on the fundamentals, and be patient.
Easier said than done, right?
It definitely takes practice.
I'm starting to see how important it is to learn how to control those emotions, especially when it comes to investing.
Absolutely. Fear and greed can really cloud our judgment.
So we need to develop a more disciplined approach.
Exactly. A well-defined investment process can help you stay grounded when the market gets crazy.
Okay, so talk to me about this investment process.
What are the key elements we need to focus on? Well, one of the most important things is to define your investment philosophy and your risk tolerance.
So what are my goals? How much risk am I comfortable taking?
Exactly. What types of businesses are you most interested in investing in?
Once you have a clear understanding of your own investment style and your risk appetite, then you can start to develop a set of criteria for evaluating potential investments.
Exactly. Think of it like building a house.
Okay.
You need a solid foundation before you can start building the walls and the roof.
That makes sense.
And just like a house needs a strong foundation to withstand storms and the test of time, a sound investment process needs a solid foundation to help you navigate market cycles and achieve your financial goals.
Okay, so we've got our foundation in place.
What's next?
What's next?
The next step is to develop a systematic way of researching and evaluating companies.
So this is where we put on our detective hats.
Exactly. You need to dig into the details, understand how the company makes money, what its competitive advantages are, how it's managed, and what its growth prospects are.
It's like doing a background check on a potential business partner?
Precisely. You're not just buying a stock.
Right.
You're buying a piece of a business.
We need to know what we're getting into.
Exactly. And just like you wouldn't buy a house without having it inspected first,
Right.
you shouldn't buy a stock without thoroughly researching the company behind it.
Okay, so we've defined our investment philosophy, assessed our risk tolerance, and learned how to research companies. What else is crucial for building a solid investment process?
You also need a system for managing risk.
Okay, like what?
Things like diversification.
Don't put all your eggs in one basket.
Exactly. And position sizing, which means deciding how much of your portfolio you'll allocate to each investment.
Makes sense.
And you also need a plan for what to do when the market inevitably takes a downturn.
So having an exit strategy.
More like having a plan for how to handle volatility.
Okay.
Because it's going to happen.
The market's going to go down at some point.
It always does. And you don't want to be making emotional decisions when that happens.
Right, because that's usually when people make their worst mistakes.
Exactly. So having a plan in place beforehand can help you stay calm and rational when everyone else is panicking.
It's like preparing for a hurricane.
I like that analogy.
You board up your windows, stock up on supplies, and have an evacuation route planned out just in case.
Exactly. And a well-prepared investor can navigate market downturns in much the same way.
So we're not just trying to avoid losses.
Uh-huh.
We're also trying to take advantage of those market dips to buy great companies at bargain prices.
Exactly. Turning lemons into lemonade.
Okay. So we need to define our investment philosophy, research companies, manage our risk, and have a plan for dealing with market downturns. Anything else?
Yes. One more thing, and it's perhaps the most important element of all.
Okay, I'm listening.
Be patient and disciplined.
Oh, yeah, we talked about that earlier.
We did, but it's worth repeating.
It's the foundation of it all.
It is. Remember, we're looking for 100 baggers,
Mm-hmm.
and that means we're in it for the long haul.
We're not looking for a quick buck.
Exactly. We need to be willing to hold on to our investments for years, even decades.
To let the power of compounding work its magic.
Precisely. And that requires patience and discipline.
It's a marathon, not a sprint.
You got it.
Okay, so we need to develop a sound investment process, define our investment philosophy and risk tolerance, thoroughly research companies, manage our risk effectively, and, most importantly, be patient and disciplined.
It sounds like a lot, but it's really not that complicated.
It's about developing good habits and a long-term mindset.
Exactly. And those habits will serve you well, not just in investing.
In life as well.
Absolutely.
Yeah.
The principles of sound investing can be applied to many aspects of life.
I like that.
It's about making thoughtful decisions, managing risk, and having the discipline to stick to your goals even when things get tough.
Whether you're investing in the stock market, building a business, or pursuing your personal goals.
Exactly. These principles can help you achieve extraordinary results.
Okay, I'm feeling inspired.
Good. Keep that inspiration going.
As we continue to explore the world of 100 baggers.
We're about to dive into some fascinating stories and examples.
Of ordinary people who achieved extraordinary results.
Stay tuned.
Wow, this deep dive into 100 baggers has been a real whirlwind.
It has. So much to unpack.
We've covered a ton of ground, from the magic of compounding to the art of finding companies with those unbreachable moats.
And we've explored some pretty incredible success stories along the way.
Absolutely. So before we wrap up, I think it would be helpful to distill everything we've learned into some actionable takeaways.
Great idea.
Something our listeners can actually apply to their own investment journeys.
Let's do it.
So first things first, let's acknowledge the elephant in the room.
Okay.
Finding a true 100 bagger is a rare event.
It is. It's kind of like finding a four-leaf clover.
Or winning the lottery.
Exactly. But the beauty of it is that even if we don't hit the jackpot,
Right.
the process of searching for these exceptional companies can make us much better investors overall.
So the journey itself is valuable, even if we don't find that elusive 100 bagger right away.
Absolutely. It's about sharpening our skills, expanding our knowledge.
And developing that long-term mindset.
Exactly. So let's recap some of those key principles we've uncovered along the way.
Okay, what are the essential ingredients in that 100 bagger recipe?
Well, we talked about the importance of high returns on capital.
Right, the company needs to be able to generate a lot of profit from the money it invests.
Exactly. And it needs to be able to reinvest those profits at high rates to fuel continued growth.
And ideally, operate in a large and growing market so there's plenty of room to expand.
Those are the foundational elements of any successful long-term investment.
And we can't forget about those moats.
The durable competitive advantages that protect a company's profits from the competition.
Exactly. Whether it's a strong brand, a unique technology, or a network effect, those moats are essential for creating lasting value.
They are. Moats are like the castle walls that protect a company's treasure.
I like that analogy.
And they help to ensure that a company can continue to generate high profits for many years to come.
We also talked about the importance of independent thinking.
Oh, yes. Being able to see things differently than the crowd.
It's so easy to get caught up in the hype or the fear of missing out, but the best investors are often those who can chart their own course.
Absolutely. Don't be afraid to be a contrarian, to bet on companies that others have overlooked or dismissed.
Sometimes the greatest opportunities are hiding in plain sight.
They are. And speaking of hidden gems, we can't forget about those owner-operators.
The passionate leaders who have skin in the game.
Exactly. Their interests are aligned with ours, and they're often the driving force behind those exceptional growth stories.
It's like having a captain who's not only skilled at navigating the ship, but also deeply invested in its success.
That's a great way to put it. When you find a company with a talented and passionate owner-operator at the helm, it's a good sign.
It is. It's like finding a rare pearl.
Exactly. And it's one of the things that separates the truly great companies from the rest.
You know, listening to all of this has really been an eye-opener for me.
Oh, so?
It's made me realize that finding 100 baggers isn't just about luck or timing the market.
It's not.
It's about having a process, a framework for thinking about investing.
Right.
And a set of principles that guide your decisions.
Absolutely. It's about having a long-term mindset.
Right.
Being patient and disciplined.
And doing the work to really understand the businesses you're investing in.
It's a journey, not a destination.
And it's a journey that can be both challenging and incredibly rewarding.
It can. And, you know, speaking of journeys,
Yeah.
I think it's time for us to wrap up this deep dive into the world of 100 baggers.
It has been an incredible adventure.
It has. We've explored so much, learned from some of the greatest investors of all time.
And hopefully inspired our listeners to embark on their own 100-bagger quests.
I hope so. And as we set sail on our own separate voyages,
Right, back to the real world.
back to reality, but armed with new knowledge and a fresh perspective.
Exactly. Let's remember the key takeaways from this deep dive.
The importance of patience,
The power of compounding.
the need for a sound investment process,
The courage to think independently.
and the wisdom to seek out those exceptional businesses that have the potential to create extraordinary wealth.
That's a great way to sum it up. So to all of our listeners out there,
Yes.
we encourage you to keep exploring,
Keep learning
keep growing.
and never stop believing in the power of long-term investing.
This is The Deep Dive. Signing off and wishing you all the best on your own investment journeys.
Happy investing, everyone.